silver loves a cup and handle, and I'm just about to blow your mind here because if we go onto the hourly chart and look at where we are now, we're below the moving average, below this smoky cloud, below the breakdown line. Now, the problem we've got at the moment is the debt has become unsustainable because we've broken out from that trend. We've got a high debt to GDP burden, and the interest rates at over 4% are very problematic. In other words, mathematically, we're going to run into some major issues here. When the stock market falls, this chart above it starts to rise rapidly, and that is silver outperforming gold. Stock market drops, silver outperforms gold. Stock market drops, silver outperforms gold.
Okay, ladies and gentlemen, so today we have Kevin Wadsworth of Northstar Badcharts, and today we will look at the US economy, commodities, precious metals, and many other very interesting topics. So Kevin, thank you so much for being back on the show.
Thanks for inviting me on, Vladislav. It's good to be back again.
Very happy to have you back on, Kevin. Very busy times, so much happening in the commodities, precious metals, and everything. But I like to start with the macro picture first. So if you look at the US economy, the recent economic data and everything, what's your macro outlook on what's happening right now?
Well, the macro outlook hasn't really changed a lot since the last time we spoke. So we spoke quite extensively about a process called capital rotation, and the capital rotation process that we've been following for the last 2 or 3 years is continuing. The capital rotation process is defined by a shift away from traditional stock markets and towards precious metals and commodities, energy, and oil. So that process is still ongoing, and I think a lot of people are probably unaware of it because stock markets are still doing okay. But what they're not aware of is the fact that the stock markets are breaking down when you price them in gold and in silver. So that process of gold and silver starting to outperform stock markets and outperforming a whole range of other assets is part of the capital rotation process that leads us into the fourth such event in the last 100 years. So risk is increasing in stock markets. Gold and silver have had a big move, of course, and that is continuing at the moment. Cryptocurrencies are struggling a little bit, and that's partly as a result of the capital rotation process, and they're certainly doing very badly compared to gold and silver this year. So they've massively underperformed gold and silver. So there's a whole range of sort of processes going on, but I think a lot of people are going to be very confused about what's happening if they're not able to analyze the technical charts. The way that we do. So it kind of takes the bias out of it, and it makes things a lot clearer.
Yes, Kevin, why are we seeing this capital rotation? Is it because people are afraid that there is a big slowdown in the economy and we are moving into possible recession, or is it even on the macro picture loss of faith in the fiat dollar currency?
You could have a very long debate about the reasons for it, but I think right at the heart of it is debt and the interest rates that are paid on that debt. I'll share my screen just to sort of help explain to the viewers what I mean by capital rotation, what I mean about this entire process. This chart, this slide, it represents what the capital rotation process is. And as all of these elements break down into a bear market priced in gold, the capital rotation process advances further. So US money supply is now in a bear market versus gold. The US dollar index, DXY, so that's the relative strength of the US dollar, that's in a bear market versus gold. Consumer prices in the US, that's CPI, and producer prices, PPI, are in bear markets versus gold. Currency in circulation, the equal weighted S&P 500 stock market in a bear market priced in gold. The New York Composite Index is in a bear market priced in gold. The Dow Jones is very much in a bear market priced in gold. The Wilshire 5000, that's a stock index, and the Russell 2000 also in bear markets priced in gold. The S&P 500, sometimes referred to as SPY or SPX, that is now breaking down into a bear market priced in gold, and so is NDX, which is the NASDAQ tech. It's the technology stocks listings in the United States. So all of these things are breaking down into bear markets. And if it was just one or two of them, it wouldn't be such a big deal. But all of these breaking down into a bear market priced in gold has only happened in the late sort of 1929, 1930, 1972, and 2002. And we know exactly what happened during those periods. What happened was the stock markets um, struggled and didn't make and sustain any new highs for 10 to 15 years. And whilst that was happening, the stock markets were going up and down, but overall they were going nowhere. Whilst that was happening, gold doubled and then it doubled again and then it doubled again. You have to bear in mind that I put this on my social media account here back in October of 2020. There's the date there, October 2024. And so in that year, since we said that this was happening, gold has massively outperformed all of these things, as we said it would, and has even outperformed, for example, Bitcoin. So if you want to talk about the charts and what I said lies at the heart of all of this, if I just bring up one of my charts here and just give me a second to do that. I've got to get the right list because I've got a lot of charts on here. But if we go up to this listing here, and then we scroll down to the US 10-year yield, this is what lies behind all of these issues and what lies behind all of these problems. So let me just get the chart so that it's maximized so you can see all of it. So this is US government 10-year yield, and I'm just going to adjust that to make it the 12-year moving average so that the label matches. There we go. So during the 1950s, 60s, and 70s, the 10-year yield on government debt in the United States was rising. And that was in that rising interest rate environment, it was made possible because the debt to GDP was falling from 70% to 30%. So proportionally, the debt burden was decreasing. So that meant that as inflation took hold, it was possible to raise interest rates and raising interest rates to 16%. So it was possible to pay 16% interest on the debt because the debt to GDP was dropping. Come 1980, and that's of course when precious metals topped at the end of that rising trend, we entered a 40-year period where the debt to GDP was rising from 31 to 129%. So therefore, this chart, the 10-year yield, was having to drop. It had to drop because the debt burden was increasing and the debt to GDP was increasing. So in other words, that the United States had to pay a lower rate of interest on that debt in order for that debt to be payable. If the interest rates broke out and went much higher, it meant that the debt became unsustainable. Now, the problem we've got at the moment is the debt has become unsustainable because we've broken out from that trend. We've got a high debt to GDP burden, and the interest rates at over 4% are very problematic. In other words, mathematically, we're going to run into some major issues here. So this is where the interesting bit comes in. GDP, gross domestic product, is simply money supply multiplied by money velocity. That's all it is. People think about GDP as being the sum total of, a country's products and services, and if a country is doing well, then GDP increases. Well, that's only part of the story. Mathematically, GDP is simply money supply times money velocity, and the velocity of money, the rate at which money is, if you like, being used, and the rate at which money is passing through the system, that's a bit tough to control because if your economy is stagnant, then money velocity drops. So the only thing you can control as a government and the Federal Reserve is the money supply part of that equation. So if you want to increase GDP the easy way, all you've got to do is increase money supply. And bear in mind what Donald Trump has just been saying for the last few weeks is that quantitative easing is ending. Sorry, I beg your pardon. Let me get the quantitative tightening is ending, and quantitative easing is about to start in a very big way. Quantitative easing, the printing of money, of course, to dig the economy out of a hole. So his whole ethos is to massively increase money supply so that GDP goes up, so that this equation becomes manageable, and therefore the 10-year yield can carry on rising. The market determines the 10-year yield, not the Fed. I'm sure during the period of the 1960s and 70s, the Federal Reserve would have loved to have a 10-year yield way below 10 or 15%, but the market determined that holders of US government debt were demanding 10 to 15% because the debt was considered risky. So the market determined the direction of the 10-year yield until at a certain point here, it was possible to tame the inflation problem before it really got out of hand. And you end up with hyperinflation. That was prevented back then. Whether we're able to prevent that this time around when the 10-year yield begins to rise very significantly, or whether not remains to be seen. But the main issue here, and to get back to your original question, what's going on here? I put this chart out about 5 years ago, and I put this yellow label on it saying, ask yourself, which assets outperformed the last time we broke above the pain line? The pain line is this red line here. The last time we broke out above what I call the pain line is back here after World War II. And what massively outperformed after World War II? Gold, silver, oil, energy, commodities, they all outperform the stock market. So the same dynamic is at play now to what we had in the 1960s. And that is the reason why silver, for example, has done this. This cup pattern for silver that's been forming since 2011. So 14 years, we've seen the price of silver drop, level off, and then start to rise in a perfect geometric arc, taking us to where we are now, which is at a very important point, actually, which I'll get to in a moment. But this black line at the top here is very significant, near $55. But if we zoom out a little bit more, what you'll notice is that this is a cup and handle pattern. That particular geometric arc there is just the handle on this enormous 46-year cup and handle pattern. And if we pop it on the line chart for a moment, and this is the monthly line chart, so it's plotting the monthly close for the price of silver every month, going back to 1980, 2011, and then this is where we are now. And that is why the price of silver stopped at $55 a few weeks ago and then retreated. And now we're coming back to try and test the $55 level. Silver loves a cup and handle, and I'm just about to blow your mind here, because if we go onto the hourly chart, so instead of having monthly candles that go all the way back to 1979, if I put this on the hourly chart, so that we've got hourly candles that only go back to, where are we? 15th of October. So this chart goes back almost 1 month, and I do this, we've got another geometric cup pattern. This geometric cup is forming directly underneath the breakout level at $55. So wouldn't it be absolutely beautiful, ironic, fitting if we were to get something like this forming that then catapults the price of silver all the way up here over the next several weeks? Now, I'm not saying that is what is going to happen, but I'm saying that will be a very fitting way for the price of silver to finally break out of a 46-year resistance level and to move to the next stage in its bull era, which would be to move to a level up here somewhere, flipping the $55 level from resistance into support, because silver is so stretched at the moment that a big correction is coming. And the big correction is either going to happen from here, and we're going to correct all the way down to, I don't know, $35, $40, or we break out now and flip this 55 level from resistance into support, and then that would usher in the new paradigm where silver is able to fall 30% or 40%, retest the $55 level, over the next, and I'm just going to put this onto a weekly time frame because that's more realistic. Let me just zoom back out here. If this was to move up to, let's say, somewhere below $100, whether it's 70, 80, 90, or 100, let's say somewhere around not just below $100. If it was to do that in the next few months and then correct all the way back down, that could take us to 2027. And I think that is entirely realistic to expect that kind of a move when you look at the size of that chart pattern. So silver is spiking now, and you can see the size of the spike back in 2008, and that was a massive move for silver. Let me just show you that arrow there. And the spike that we've got at the moment is starting to get close and similar to the size of that spike back in 2008. And we had a spike here in the late 1970s of a similar size, and another one down here in an earlier stage of the bull market in the 1970s. So it seems that the size of the silver spikes are quite comparable. So if we're in one of those historic silver spikes now, we could be somewhere just below or just above $100 next year before a major correction starts. All I'm doing here is laying out the possibilities and trying to put into context what is possible. And of course, if silver does that, then gold is probably going to be somewhere, I don't know, around $5,000 or $6,000 by the time silver's done that. But silver, of course, is currently outperforming most instruments, including cryptocurrencies, of course. And if you look at this is the S&P 500 versus gold, and what it shows is a very, very important breakdown is occurring where the stock market, and if I just zoom out a little bit, the stock market peaked priced in gold 25 years ago in the year 2000. And at that point, the stock market plummeted versus gold. And compared to gold, the stock market fell by nearly 90%. Just let that sink in for a moment. The stock market lost 90% of its value priced in gold. And then there was a recovery for the stock market priced in gold. And now it's rolling over back into a bear market. Bear markets occur below the 36 and 48 month moving averages. That's the green line there. That's a 36-month moving average. And this red and green splodge that you see on the chart is called the Ichimoku cloud. So bear markets occur below them and bull markets occur above them. And look at where we are now. We're below the moving average, below the Ichimoku cloud, below the breakdown line for the S&P versus gold. So we are currently, despite everything that the stock market has done in the last 10 years, we are still 70% down on the peak 25 years ago. And in fact, the stock market has fallen nearly 40% priced in gold just in the last few years since 2021. And if you measure it from 2024 there, so around about 18 months ago, we're down 35%. That's bear market territory for the stock market priced in gold. You can look at gold versus the NASDAQ as well. And gold is breaking out versus the NASDAQ. So when this chart goes up, it's a bull market for gold versus the NASDAQ. And at the moment, the chart is breaking out again. I'm just going to put the 4-year moving average on here so the labels are correct. And you can see this ratio chart is above the 4-year moving average, the green line, above the Ichimoku cloud once again. And we're very, very close to this horizontal resistance line that previously in 2001 marked the breakout for gold versus NASDAQ. And once again, this level on the ratio chart is marking the breakout level for gold versus the NASDAQ, and we're very close to breaking through it. So something is going on here, Vladislav, something's going on, which is a paradigm shift for precious metals and everything associated with precious metals, the miners and all of the other precious metals and base metals, commodities, and the stock markets. The stock market itself, I've got to make this point, stock market itself has not yet broken down. So the stock market's fine, it's okay. But the main point that I'm making here is that gold and silver are massively outperforming the stock market. So investors, hedge fund managers, bullion banks, they're all aware of this. And so there's a steady shift of money into the precious metals that is outpacing the shift of money into stock markets. So therefore, precious metals are going up at a greater rate than the stock market. And it's that dynamic that is going to cause the next phase, which is where the actual stock market priced in US dollars breaks down into a bear market. That might happen next week. It might happen next month. It might happen in a year or two. I don't know when it's going to happen. All I'm interested in is the fact that I'm making more money in precious metals and related assets than I would if I had my capital invested in the stock market. And until or unless the stock market breaks out versus gold again, I'm going to continue allocating to gold, silver, the miners, and energy stocks, uranium stocks, oil stocks, all those kind of things, because all of the evidence that I've just shown you points to a new era of commodities and precious metals outperforming stock markets. And that leaves a big question hanging over cryptocurrencies as well.
Just a very quick break, guys. So I've spent the last 12 months creating this course, Wealth Building Blueprint. I've put an unbelievable amount of effort into it. I cover investing, trading, speculating, business. The course is perfect for people who are still relatively new to this wealth building process. And I also offer 3 days money back guarantee. No questions asked. If there's absolutely anything that you're not happy with, you will get your money back. There's also a private community where you can ask me any questions, you can talk between each other, you can share news and things like that. The link will be in the description. Right now the course is at a 70% discount, and let's continue with the video. This is why I love talking to you, Kevin. Fascinating stuff. If we could talk a little bit about stock market. So with Trump possibly wanted more quantitative easing, would that not be bullish for the stock market historically?
I'll show you my screen again. I've just got to pull a chart up from my files here. So just give me a moment. I mean, a lot of assumptions are made based on. I'm just looking over at one of my other computer screens on the right here. So just excuse me for looking away for a moment. There's a lot of assumptions made about the behavior of the stock market in relation to quantitative easing and in particular easing cycles for interest rates. And I'm just going to share that screen for you. Let me just make sure I share screen number 1. Okay, here we go. So this chart here, let me just move something out of the way there. So yeah, this chart here is showing you what happens to when the stock market drops. It shows you that silver outperforms gold, and that's not actually the chart I was wanting to show you, but it is a point worth illustrating actually. When the stock market falls, this chart above it starts to rise rapidly, and that is silver outperforming gold. Stock market drops, silver outperforms gold. Stock market drops, silver outperforms gold. So silver's big outperformances come after stock markets have bottomed. So just keep that in mind. The chart I wanted to show you was rate cuts. Here we go. Let me just get this on the screen for you. So rate cutting cycles, and everyone's getting all excited about stock markets and cryptocurrencies because the assumption is that stock markets, risk assets, and cryptocurrencies are going to go to the moon because we're entering a rate cutting cycle with quantitative easing. Well, look what's happened in the past. Rate cut cycle, stock market plunged over 30%. Rate cut cycle, rates falling, stock market initially plunged something like 30, I think that's 30% roughly. Rate cuts in the year 2000, stock market fell around about 50%. Another rate cutting cycle, 2008, stock market fell over 50%. So my point here is that it's not the rate cuts that are and the quantitative easing that's determining what the stock market does. It's where the stock market is in its cycle and where the economic cycle is. It's a case of, are the rate cuts being done for good reasons, or are they being done for bad reasons? What is actually going on underneath in the economy? And so the idea of quantitative easing and rate cuts causing stock markets to go up and cryptocurrencies to go up cannot be um, assumed. You have to look at, I think it's more valuable to look at a ratio chart of gold versus the stock market, or just simply look at the stock market chart itself, because if the stock market begins to break down on its weekly chart and it starts to break support levels, then you have to question the narrative. And this is what I say a lot of the time, is that people love a story. Vladislav, I'm sure you love stories as much as we do here in the UK and across in the United States. The human condition is all about stories and passing stories on from one generation to another, and that's kind of in our psyche. And if we are invested in something, if I'm invested in gold, or if you're invested in cryptocurrencies, you've got a bias. You want them to do well. You want your investments to do well. So if you hear a narrative and a story for why they're going to suddenly start doing really well, you're going to latch onto that and you're going to just accept it. You're going to accept that because it supports your thesis. What you should do is what I just did there, and I did that chart a few years ago because people were saying this. People were saying, "Oh, rate cuts, therefore stock market's going to go to the moon." I thought, well, is that true? Let's just get a chart of rate cuts on the computer screen and get a chart of the stock market, put them next to each other, and we can see if it's true. Sometimes it's true, but sometimes it's not. So clearly, there is, that narrative isn't any more reliable than flipping a coin, because it's about 50-50. You might as well flip a coin to determine whether stock markets are going to go up because of a rate cutting cycle. There's a lot more to it than that. And things like that 10-year yield chart that I just showed you, what's going on in the economy, what's going on with gold in particular, because gold is a canary in the coal mine. Gold doesn't do anything. It just sits there and it measures what is going on around it. Okay, so if there is a lot of trust in the system and everyone's doing great and everything's fine and firing on all cylinders, the purchasing power of gold will fall. If there's an issue, if there's an underlying problem, and there's a loss of faith and trust in the system, then the purchasing power of gold will rise. And that's fine, but it's when the purchasing power of gold rises compared to the stock market that it's a real warning sign. The fact that gold went from $2,000 to $2,500 or even $2,800, that wasn't a massive red flag. But what was a massive red flag was when gold went from $2,000 to over $4,000. And in so doing, it started to significantly outperform a whole range of assets. And that's a warning sign that there's something not right, as it was the case in 2001, 2002, as was the case in the early 1970s, and as was the case in the very early 1930s. We had a stock market crash of over 50, I think it was about 80% actually, wasn't it, for the stock market? So, something's not right. Yeah, the bubble could be kept inflated for longer than you might imagine, but it doesn't change the fact that something under the surface isn't right. So the capital rotation process is ongoing. The capital rotation process is gold being in a bull market, silver being in a bull market, and outperforming all those other things that I showed you at the start. The capital rotation event is the stock market crash. Capital rotation event is what finally confirms that all of this has led to the event, and the event is that initial very large drop for the stock market, which might be around 25 or 30%, and that is the final confirmation that we're in a precious metals bull era. Not a precious metals bull market, but precious metals bull era. A bull era is when gold and silver um, are in a bull market for at least 10 years, and they're outperforming pretty much every other asset through that period as well, through that entire 10-year period. So gold and silver, when silver's in its bull era, it's hard to find an asset that is outperforming silver for any period of time. You might find uranium stocks or oil stocks for a short period of time will outperform silver, but over a period of multiple years, silver is very hard to beat when it's outperforming gold, and spiking ridiculously to the upside and doubling and then doubling again and then doubling again. Silver should get somewhere around the $300 mark by the time the 10-year time frame is complete in the mid 2030s.
Really good points, Kevin. And I loved your point on stories because you can just see by how people react to events that they want to use every single opportunity to buy the stock market because, as you have said, they're invested and they want it to do well. That's actually, you can see it with your naked eyes. And if Kevin, if we could look at mining stocks as well. So in theory, with this type of performance, possible performance in precious metals, they should do really well as well.
Yeah, okay. Well, as always, it's a lot easier to understand with a chart. So I'll go back to the charts and we'll take a look at first of all, we'll just take a look at the ASA index. It's it's a gold and silver precious metals index, and the reason I use ASA, it mirrors the GDX, but it goes all the way back to the 1960s. So it's much, if you're wanting to do some technical analysis on the chart, GDX doesn't go back all the way to the 1960s, but ASA does. But if I was to put on GDX, and I'll just do that for you now, just to prove it to you, GDX, new price scale, I'll just put it onto a log chart. I'll just adjust so there you go. There's the GDX chart. The blue chart there is GDX. That's the gold miners. And you can see, can't you, that it exactly mirrors the ASA chart, but it only goes back to 2007. So if you want a full view of what the gold and silver miners have done over a longer period of time, then you use ASA. So what's happened is that we've broken out above this paradigm shift breakout line. And if I just pop it on the candle chart for a moment, you can see that back in, where was it, August, the candle stopped at that line. It hesitated. And then in September, we broke out. So now that line, that resistance line, is support. And any pullback should terminate around about 38 on the ASA index. So we can measure the percentage drop from the top to the bottom there. And at the moment, a 30% drop is about as much as you would probably see in the ASA index. The higher we go in this move, if we were to come up here, then of course the percentage drop could be 40% or more. And if you think that's scary, then look at previous bull markets. We had a bull market move in the 2000s here, and the ASA index, the gold and silver miners, fell 40% there. And then a little bit later in the bull market, they fell nearly 70%. So, don't be playing around with the miners if you don't like big drops. Back in the 1970s, actually, the gold and silver miners never outperformed gold or silver. So the mining indices in the 1970s did not outperform gold and silver, but there were individual mining stocks that did. But again, there's a 70% drop. So when you get to the end of a particular run in the bull market, you're going to need an iron stomach to be able to watch your portfolio drop by 70% before it makes a new high. Very volatile. So, my message there is, you know, for me personally, I would have the bulk of my portfolio in physical gold and silver, and have a smaller portion of my portfolio dedicated to the miners. So perhaps maybe 10, 15, 20% of your portfolio made up of miners. That way, if there is or when there is a drop of 50% or more, you're not going to see your entire portfolio falling by 50%. Because of course gold won't fall that far. Silver might, but probably not quite that far. Gold will probably have a drawdown of more like 30%. So the miners are in a good position. They've broken out, but the more important thing, if we look at something like the let me just get a good chart here. This is the silver junior miners versus the stock market. And you can see that we had years of silver junior miners underperforming the stock market because this chart, it went down and down and down and down and down until it broke through this resistance level. I said it was all noise until we break through that line. And we did break through that line back in the summer, well, in July of this year. So we broke out and we've moved to the first resistance level. The first resistance level is where we are now. So this is the silver junior miners versus the SPX, the S&P 500, or silver junior miners versus the stock market. So what I'm trying to say to you is that we have only just started to break out versus the stock market. And if we use that chart as again, which has a bigger history, it gives you a much better perspective of just how early we are in this move, because the gold and silver mining index from 1980 all the way to 2000 fell something like 80%, 98%. So the gold and silver miners lost 98% of their value versus the stock market during that period. That just shows you that holding gold and silver miners over long periods of time is not the thing to do. The thing to do is to identify when they break out and then to hold them for a short period of time until you feel that you've made sufficient gains without being too greedy. And personally, for me, sufficient gains without being too greedy is going to be where this red line is that I'm about to put on the chart. Just there. There you go, that red line there. So this box here, we haven't even broken out of it yet. So the gold and silver miners have been bouncing around in this yellow box for over 10 years. And we haven't even broken out of it yet. So once we break out of it, the gold and silver miners should outperform the stock market by 249% by the time this ratio chart gets up here. So that'll be a combination of the stock market showing weakness and falling, but also the miners showing relative strength and actually going up in US dollar terms. Now we may progress to the next level, and we may even go higher than that. There's no way of knowing for sure. If we were to get all the way back up here to the top, then it would mean that the miners had outperformed the stock market by 7,000%.
Yes,
So that is possible, particularly given that this is a major, what I would call a major event for the precious metals, something more comparable to the 1970s than the early 2000s. So, that level up there is possible, but I would probably bail somewhere between that red line and possibly the next level up here would be where I would be comfortable taking profits. And I'm not going to hang around to try and catch the tail end of the bull market when risk is high and all of the big gains have already been made. The big gains are just about to start. So if you choose your mining companies carefully and you pick wisely, you can pick companies that are outperforming both gold and the stock market by using these ratio charts.
Great points, Kevin. Before we wrap up, if we could look at uranium market as well, the physical and possibly a few of the miners.
Yeah, sure. Okay. Let's take a quick look. I'll put that screen sharing back on again. Okay, so taking a look at uranium, I use the URA chart. It's an ETF for the uranium sector. If I can just find it on the list here, I've got so many things on the list. A bit further up here somewhere, I think it is. There we go. So this is the URA chart. It's the Globalex Uranium Miner ETF, and it gives you an idea of the general trend for the uranium sector. And this roadmap I put out back in 2020, and I drew this cup pattern which I said at the time would guide us to the target area at the top right-hand corner. And I've got no reason to change that forecast at the moment. We've hit the initial target area, which is this sort of red shaded zone just down here around the 50 to 65 area. And we actually got to around about, what was it, 60, just over $60 on this uranium miner ETF. From the breakout down here, where we said that the bull market was starting, the price has gone up by a factor of 5 or 6, gone from 11 to that sort of 55 area. Sorry, 60 area. So the forecast for the coming, let's say 2 or 3 years is whatever pullback we're undergoing at the moment will take place, and will probably give some good entry opportunities in the miners, and then an acceleration to the $100 plus area. And I don't think it'll stop there. I think it'll probably go beyond that. And one, I keep talking about ratio charts. One thing that is keeping us out of the uranium miners at the moment, to a large extent, is the fact that they are not yet breaking out versus gold. We've got a position in Cameco for our website members that's up something like 300 or 400%, I think it is at the moment. But the majority of the uranium miners, the mid-tier and lower tier explorers and developers, haven't really made their massive moves yet. And so that's going to happen when this ratio chart breaks out above this red zone here. So when we get a clear breakout through this horizontal resistance zone, and I'll just put some of these indicators on the chart that are labeled. Got a 3-year moving average there. Once we break out above that red resistance zone, then the uranium miners are going to enter a much more energetic period of outperformance versus gold. So that's when it's worth holding the uranium miners. At the moment, gold and silver are where you should be, because they're outperforming a wide range of assets, including the stock market and cryptocurrencies. And uranium miners, although they've tried to break out versus gold, there's a breakout down here. Since the initial breakout, they've actually sort of gone down a little bit versus gold. So we want to wait now for this ratio chart to break out, and when it does, that's when we get back in. So I've already mentioned Cameco. If I pull up the chart for Cameco, you're going to see, and I wouldn't really look any further than Cameco at the moment, because when you compare Cameco's performance to pretty much all of the miners in this list, and there's a lot of them, there's probably 40 or 50 uranium miners there. It's almost impossible to find a uranium miner that is outperforming Cameco. It's where the institutional money goes, and Cameco, of course, has outperformed gold. And as I just showed you, for most of the uranium miners, that isn't the case. So we are above the 3-year moving average. We're above the Ichimoku cloud. We're in a clearly defined uptrend. And if I just put it on the weekly chart there, you can see that we've broken, or we're trying to break out through this resistance line at the moment, just back testing it as we speak. So it's going to be interesting to see what happens here and whether this pullback develops any further. But at the moment, other than Cameco, I wouldn't go headlong into the uranium miners right now. I would wait for them to break out versus gold and just hold those core positions in gold. If you use, don't forget, of course, that you don't have to have physical gold. These days, you can hold digital gold with a whole range of companies. There's companies like Kinesis Money and many others where you can, obviously put your fiat currency in there, transfer it into gold and silver, and then when you want to buy some stocks or shares, you can quickly sell your gold and silver in a matter of seconds and just then transfer it into your brokerage account to buy mining shares, or you can buy cryptocurrencies in the same account. But all I'm trying to say is that when I say sell your gold and silver to switch into miners, it's not as difficult as you would think. You can do it in 5 or 10 minutes. these days, unless of course you're determined that you have to have your physical gold in your hand. Some people want to hold their physical gold and silver, but for me, I prefer to spread my risk and combine that with holding gold and silver digitally, which means that you can quickly jump in and out of your gold and silver positions at minimal cost.
So, Kevin, we covered a lot. Uh, if there's anything else that maybe you would like to mention that we haven't covered.
No, I don't think so. Just if you like this kind of analysis, of course, then you can find me on X at Northstar Charts on X, and we do have a website. I think you mentioned it last time we spoke. It's northstarbadcharts.com, and of course it's Black Friday coming up soon, where everybody offers big discounts, and we'll be doing the same. So if you like this kind of analysis, feel free to take a look at the website, sign up. If you don't like it, you'll get your money back, and no problems at all. So if, as I say, if you like this sort of analysis, come and have a look and see how you get on.
Yes, I will have all the links in the description below, and I have been using this service for more than 4 years, and I highly recommend it. So, Kevin, I really enjoyed the conversation like always. Thank you so much for your time, and I'm looking forward to having you back on the show.
Thank you very much. Thanks for having me again. Bye bye for now.